Everyone, as you all know, I have started a 50 days challenge in which I am going to teach everyone how to build wealth and how to build the correct mindset, in fact, for to building the wealth. As you all know that I have made many videos on many topics like SIP, what is mutual fund, what is the stock, what is stock market, what is fundamental analysis, what is technical analysis, why to stay away from trading in the initial days as a beginner, how to save money, and how our diversification kills our returns and everything like that, and why the main question like the middle class always takes the middle class and the EMI traps and loans and everything. But now today I'm going to tell you all that how to analyze a stock fundamentally. I will show you. Okay, I have already made a video already, and this is not a promotional video. By the way, I'm going to use the ticker phonology for it, and I generally use it because it's a good tool. I think it is free of cost. I mean, I'm using the free version. Then let's analyze one or two few famous stocks. There will not be a buy sell or that recommendation from my side, but it's just a pure review from my side that how to analyze any stock fundamentally. Okay. So first of all, here we will see the option of standalone and the consolidated. This is the Reliance Industry stock. As we all know, it is one of the most famous stock in our NSE and BSE, that is the National Stock Exchange and the Bombay Stock Exchange. We need to click on the consolidated part so that all the holdings this companies has, we will get the combined report of all in the one. Okay, which market capitalization is very good. As we all know, it is one of the main stock on the Nifty 50. The enterprise value. The enterprise value means if you want to buy that company currently, then what is the value? It is the market cap and plus all the cash reserves, all the debt and everything is added, and then this enterprise value is made. How many number of share is there? So for if you divide the enterprise value with the share price, it will be the number of shares, right? This is the called PE ratio. PE ratio means price to earning. That is per 1 rupee the company earns. We pay the company 22 or 23, 22.78 rupees currently. Okay. And this is the PB. That is the price to book value. This is the face value of the stock. It is generally 1, 2, 5, or 10 rupees. This is the dividend yield. That means every year from the company's profit, after the operating profit is calculated, either the company decides that the extra money, the extra profit will go into the growth of the business, in setting up the factory or the new store or the enhancement of the business or anything like that, or they just split amongst their investors. So, and generally the promoter share is also in these big companies like 30-40%, right? So they also get a liquid money. So they give dividends to just attract the investors to buy the share. Okay, what is the book value, what is, yeah, I will only tell you the main ratios. Okay, to see this is the cash, that how many cash the company has currently. So that, for example, it has 3,13,966 crore debt, out of which one fifth, that is almost 20%, they can pay right now because they have almost 70,000 crores in cash. This is EPS. EPS means earning per share. That means per share, per 1359.75 rupees, how much money the company earns. And what is the promoter holding is almost 50%. And what is the sales growth? What is the profit growth in the last 1 year? What is the ROE? ROE means return on equity. That means, for example, 50% this and 50% others, total 100% market capitalization is there. So how much on the equities, on how much of this the company earns? What is ROC? ROC is the market capitalization plus the debt. Using the debt, if the company is earning more, then the debt is good. I mean, not good, but it is justifiable, what I can say. And we should see this FCFF per share. FCFF per share is free cash flow per share. That means the EPS is 59 rupees. Okay, so we may see that, yeah, the company is earning almost 60 rupees per share. But no, free cash flow per share means after the all the investment that company has, all the debt that the company has to clear and everything, how much money they have that they don't need to put back into the business to set up the business, to keep the business running, to keep the stores, to open new factories. So it should be positive. It should be almost around the EPS, and only this company is considered good for the long term. Okay. And interest coverage ratio is one of the most important ratio that we all neglect. But for example, the higher it means that the higher the capability of the company, it is to clear that debt as soon as possible. Okay. And this is the cash cycle. Cash cycle days means in how many days after the order is booked or after the company delivers the product or the service to the customer pays the bill. So if it is negative, it is the best. So that we can see that 42 or 43 days ago, the payment comes to Reliance and then they deliver the services, which is very great. Okay. Although the debt is more currently, as we can see, but we know that they are huge businesses, right? They sit on high cash and they have multiple other investments and like that. And here we can see the long term, for long term, we can see the charts also that in the 5 year, if we consider that Nifty gives almost 10 to 12% returns per year. So in 5 year, the Nifty would have given returns around 60%, and for CAGR means per year, Nifty would be have given 10 to 12%. So this stock ideally should give 10 to 12% per annum, but it hasn't given, right? In 3 year also it hasn't given. In 1 year, in fact, it's negative. In 6 months, it's very negative because as you all know, the markets are just ripping down, just falling. Okay, so this is a 1 month chart, and we can also see that, for example, in the long run, whether this stock is overvalued or not, is price whenever the price needs to be increased, the P ratio will naturally increase. Okay, and here we can see all the peers competition, like what is the PE ratio with respect to other its industry competitors. The PE ratio is high, okay, and the debt is also a bit high. And here we can see the ROE, ROC 3 to 5 year charts and everything like that. It is growing or it is shrinking, everything like that. And this is another important ratio, guys. That is CFO upon CAC. That is the cash flow operations divided by the profit after tax. That is profit after tax ratio. Many companies, what they do show the orders before the quarterly results are coming, and after the results have gone, we don't know about it. Okay, and the order gets cancelled due to some reasons or anything like that, so that the company is not able to generate cash out of which the profit they are showing. But here it is above one. The above one ratio is very great. Like the company is showing the profit, but they are also getting more and more orders than they are showing in the quarterly results or the yearly results. We can say that. Price to cash flow is also good, and interest coverage ratio, as I explained you. Debt to equity is a bit more, as I discussed, but that's all right. Okay. And what we can see is, according to me, not and it's not my recommendation to buy, sell, or hold any stock. I'm just asking and telling you how to analyze in stock. So in March 2025, the promoters were only 50.11%, right? Then the decrease it to 50.07, then 50.01, and then right now to 50. So that promoter does not have much interest, or we can say that they don't think that it will last too long, so that they have just decreased the holding by 0.11%, but that 0.11% also of 18 lakh crore, I guess, if I'm not wrong. Let's see the market cap of it. Yeah, 18. Yeah, I'm good. And with it is in crores, okay? 1, 2, 3, 4, 5, 6, 7, and divided by 100. So this much amount of money they have liquidated from their company. So I mean, I just don't feel it like to invest more currently, according to me. But let me clear again, it is not a buy or sell recommendation. It is the blue chip stock. It is the part of the Nifty 50. And as Nifty 50 grows, as the Indian GDP grows, this company will grow because it is into multiple businesses, right? As we all know. Now let's see how to analyze the quarterly results of any company. Okay, but we should see one major column, that is operating profit. Operating profit is the cash that they are generating from their core businesses. Okay, so 43,832, 42,9 from 45,885 to 44. I mean, it is almost constant. Sometimes a bit decreasing, sometimes a bit increasing. Not much change. And what is the other income? The other income was highest in June 2025. So we must wait for June 2026 result. If it is the same, then what should we do? Then we should wait for another June. That is on March 2027. After March 2027 result, we should see that yeah, June 2025 warning was very great other income. And if it is same for June 2026, then we should target this stock for June 2027. Okay. So that if the quarterly results are good, then generally the stock price increases. I'm not saying always. Okay? It is the what is the other column? That is depreciation. Depreciation means the company has factories, all the gadgets, all the assets. It has its stock, it has its inventory, and its value decreases day by day. Okay, as we all know, for example, an iPhone or any phone, Samsung phone, any Android phone, new phone, if it is of value 1 lakh today, and after 1 month its value will decrease. Okay, so like this, the depreciation, the higher the depreciation, it is worst for the company. Okay, but as we can see, it is almost again constant, so not much thing to worry. Interest is very high, 6,000, 7,000 crores per quarter, but it's all right. The profit also is high, as we can see. So this is another important point, that is profit after tax. Profit after tax was increased in June 2025, but then it is constantly decreasing, so it's a bit of a sign of a worry. And as I told you, the promoter holding is also decreasing. So yeah, let's see. What is the consolidated net profit after every adjustments of interest and blah blah everything? It is this, okay? So this is how we should see the quarterly results, and this is the profit and loss statement year-wise. So here also, as we can see, the profit is increasing. The operating profit is constantly increasing. That is, the business was the market leader, and it is the market leader currently. But we can't say anything about the future, right? And this is the other income. It is also increasing, and interest is also increasing as they are taking the debt. The depreciation is also increased by a double amount, so that we should expect the profit to grow by that amount, and it has also grown. So yeah, we can say that they are doing great. They are doing great job. This is the borrowings. It has also constantly increased because as the business grows, anyone doesn't has that much cash, right? They also need the cash from the market itself. But see, the operating profit has been increasing, that is from their core businesses, but their investing cash flow is constantly negative. That means they are investing heavily still in new plants, new stores, inventory, and everything like that, in advertising and everything like that. Financial cash flow is negative. That means they are here doing some losses. That means if they have bought any company or any other business, any other small delivery partners or anything like that, their share of that in that company has decreased. That comes under financial cash flow. In operating cash flow comes only the profit and loss from their core businesses. Investing means, as I told you, the inventory and stock and everything. And this is the net cash flow was negative in 2021, then it became huge positive, but again a setback. It became almost one third. So it's again the matter of concern, at least for me. And this is all the holding persons, the famous personalities they show here in the ticker. Yeah, yeah, all the shareholders, and you will also be able to see the all the reports, annual reports, and the rating review reports. And if you are free, you should, if you are a long-term investor, you should be eagerly opening this and reading this as well for the director's message and everything like that. These are all the official documents, as you can see. Yeah, and once again, let me tell you, this is not an advertisement for Technology or Ticker, but it's free for you use, and I'm using it. Let's analyze one more stock, one more famous stock, like let's HDFC Bank, because it is in news from many days, like because as you all may be knowing that their chairman just I guess one of the chairman just resigned, but that's why the share has been. Let me first show you. It has fell by a huge, huge amount. It is the most blue chip stock with Reliance. It is one of the main stock of Nifty 50, and in 5 years, it has almost given 0% return per year. Almost zero. This is considered. While Nifty has given 10 to 12% per annum in the last 5 years, that is overall 60%. This stock has only given 2% return. So can we consider it as a downfall for the HDFC and the Reliance, or they are ready for the major movement? Okay, let's go for it, guys. Again, as I told you, don't forget to click the consolidated button if available, so that we can see the whole picture of it. This is the 52-week high and low of the stock. This is the current 2 days high and low of the stock. And as we can see, the market capitalization again is very good. There are different ratios that we should consider for different industries, right? For example, the PE of 22 was high for Reliance because of its peer for having the low PE. But here in the bank, yes, we can see the 15.38 PE of the HDFC is almost lower. Because as we can see, the new banks like ICICI and many other like Kotak and this AU Small Finance has even higher PE ratio than this. So there is a different I mean different ratios that we should see for different industries. Okay, comment down in the video what stock or which sector you want to make me the video on, so that I can tell you all the main ratios you should consider for it, and then focus on that sector or that stock. Of course, I am not recommending you to buy, sell, or hold anything on based on my recommendation, but just my goal is to make you educate on the topic that I know, so that the financial literacy increases. Okay, now let's go ahead. Yeah, the CASA ratio is important for the banks. So what is the CASA ratio? It is the percentage of the current account and the savings account to the deposit account. Okay, as the higher the CASA ratio, higher the profitability of the bank. Because the CASA ratio means the current and the savings account, banks provide very less interest instead of fixed deposits. Okay, so and they charge also on many services for the current and the savings account, like the SMS charge, the monthly charges, the yearly maintenance charge, etc., everything, and they give loans also on that current and savings account. So as the percentage of the current account, the savings account increases for the bank with respect to the fixed deposit, it is good for them. Okay. So yeah, if higher this percentage is, higher it is good for any bank, the bank you are analyzing. Dividend yields generally it is higher for the banking stocks because they have a huge amount of profit and income from the in the interest of the loans that they give, the credit cards, all the other schemes, all the maintenance charges, and that profit once the bank is set up all over India or all over any its region where its target audience is, they don't need much money to run their branches and everything like that. Okay, so they usually give huge dividends. 2% is considered as a good. Okay, because for example, it's 800 rupee share and two rupee you consider per share. 2% for the dividend. It is 16 rupee per share. Okay, so yeah, that's great. That's considered good. Promoter holding is 0% because of course the bank is managed by generally institutions or the organizations, not by any single person. So this is not an important ratio for this banking sector. ROE and ROC, while it is considered that important, but we cannot consider it in this banking sector as the debt is generally higher in this sector. Because what they do take the money in the form of fixed deposit from the users and give 6 to 7% interest to them, and they give it to they give that money to the market to make it flow as a loan, and they charge minimum 9 to 10% interest. So the 3 to 4 percentage gap on that money that they earn, they have to pay the salaries of the employees, they have to run their banking websites, and they have to make lot other things, right? Yeah, so they manage everything from that. So these two are also not much important ratio in that case. Of course, EPS is important that we all know. Cost to income percentage, it shows that the lower the ratio is, it is the better for the company, because cost to income means how much percentage of cost that the company has to put on to just get some profit, right? For example, if for every 100 rupee profit that the company makes, 61.53 is the cost of income. That is, they give interest on the FDs, on the savings account, current account, 2 to 3% they give 3 to 7% of the FD. On the other schemes like SIPs and mutual funds, they have to give some interest and everything like that. So this is the cost to company for each 100 rupees. 61 rupees is the cost, all the costs like the employment, the salaries of all the employees, the cost of for running the websites and everything like that. Okay, so that is that. Yeah, so the lower it is better for the bank. Okay, is the ratio? What is the CAR ratio? It is generally a bank have to capital equity ratio is likely safe and likely to meet its financial obligations. That means it is the lower the better. Okay, it is lower the better. Yeah. So profit growth is also great, and as we can see, other many of the ratios, FCFF, I told you it is a common ratio that we should see for all the industries, as I told you, and its debt is very high, 2,56,548 crore, but it's all right because the banking sector, as I told you, they have huge debts, but they have huge income as well. Okay, and this chart, as we saw that Nifty is also crushing, and this bank's one of the senior manager has retired. So in banking sector, generally it's there that if any senior manager who is managing the bank if retires, then the people's trust gets just on and off. But as we all know, HDFC is one of the highest trusted bank in India. It is one of the most finest international banks that we have in India, and yeah, it's functionally good. As we see, the PE ratio and the PB ratio is also in the control. Let's see few other ratios, important ratios. This is the advances growth means the company year on year how much amount of money that they can get without any extra cost. That is how much trust people do on them so that they can get that money in the current and the savings account at lower interest rate and they can give it back to the market in the form of loan with higher interest and can earn high amount of money. So the higher is the better. So it is higher for the HDFC, I think, than many other banks, and it is the cost of liabilities like all the average cost like interest of FD, interest on current account, savings account, and SIPs. They have many funds, how much return they need to give on them, and everything. This is the average percentage of it. So every 100 rupee they take, they need to give 5.5 rupees as the cost of liabilities to bring 100 rupee to the table. Okay, the cost of employee salary and everything go to the website and is not deducted still. But this is just the basic cost that for each 100 rupee, they need to first give 5.5 rupees, then they will get the 100 rupee. So the remaining 94.5 rupees, they need to work on it. Okay, they need to give it on the loan and then take on interest and like that. And in banking sector, ROA, return on assets, is very important. Like they have assets, okay? Like people take loan on gold and on home, okay? They keep it as collateral, okay? So the car, gold, home, anything they keep it as collateral, and if they are not able to pay the interest back and all the also on the money, it is called return on assets. So it should be increasing, right? As we can see in the last year, it hasn't been so good, but as we all know, it's a great bank, it's a huge bank, they will manage somehow, and as we can see, the average is still good. Okay, and what is it? NPA. This NPA means it is lower the better. NPA means for example, they are not able to recover the loan that is being paid. Uh, Okay, no, sorry, that is NIM. Okay, that is NIM. NIM means the lower is the better because it shows the number of users that took loan and they were not able to. Yeah, so now let's see NIM. NIM means it is the amount paid to the lenders by the banks. Okay, that means on how much percentage the bank takes the money and how much percentage is in between they give loan and they take money from. So it is constantly 5 year average is 3.76 and 1 year is 3.66. There is no much downfall even though the bank has grown much in the 5 years, right? And NPA means the amount of loans that user give. What does NPA mean? NPA means that the amount of loan that the bank is not able to recover from the users after giving it. Okay, so it should be lower, and it is in fact zero because it is huge bank and it doesn't uh, have much of that users. It doesn't give loan to such users, right? And as we can see, the FIs, which foreign institutional investors are 44%, which is a huge number. Domestic institutional investors are also more. Public is also very much excited to go for it. Here is the pros and the cons that if you need to see. And I have explained you that operational expenses, that is, we need to see operational cash flow in other fields and operational expenses for the operational income here you can see, or you can just simply see the profit after tax for every quarter, and it is just increasing and increasing and increasing. At last, you can see the consolidated net profit. It is also increasing after all the interest and all the expenses that they pay. Here is the yearly result or yearly profit loss statement that we can see operational. We should see, but we will see the profit after tax. It is also doubled, more than doubled in last 5 years. So it's a great thing about this bank. And still, in 5 years, the price has moved almost only 2%. That is the least. Okay, we could expect from these blue chip companies. Again, all the big names who are holding this stock. Yeah, and let me give you once again the advice that it is not the advice from my side to buy, sell, or hold any of the HDFC or Reliance or any other stock. It is just for the educational purpose. Invest at your own risk. And again, please like, comment, and share on my videos, and comment below on which topic, on which share you want for the next video. Thank you, guys.